Since 2020, 80% of every dollar in history has been created. So in hundreds of years, we printed only 20% of every dollar that ever existed. And in, let's say, 4-ish years, we've printed 80% of every dollar that's ever existed in the US history.
Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I am thrilled that you're here. And we are going to go off on a tangent today. I don't know if I should call it a tangent, but definitely a different asset class that we don't normally talk about on this show. And I think you're going to get tremendous value from the gentleman I've got on today. He's a very, very sharp cat. His name is Nic DeAngelo, and Nic is with Saint Investment Company, and they do the industrial space. They also do mortgages, and so we're going to have a lot of fun digging in on those two topics, because they're both very interesting to both me and should be to you as well. Welcome to the show, brother.
Hey, Rod, great to be with you here. Great catching up beforehand, and look forward to talking about a lot of fun stuff.
Yeah, absolutely. So why don't we get started with your bio, with your background in this business, and why real estate, when you got into real estate, if you had a progression or an evolution in your real estate life cycle to date, and then just do that at a high level and bring us current.
My background in real estate came from the entrepreneurial perspective. I always wanted to be an entrepreneur. I always wanted to lean into that. I always felt most comfortable kind of steering my own ship and driving ahead at my pace. But I hit an interesting wall, and the wall was that future growth and the best things that I needed to do to take things to the next level for me and my team was to make sure that we were going into things with higher returns, that we weren't tying our efforts directly to our returns, that those things weren't intricately linked. So what we did.
Whoa. Sorry. That you please elaborate on that, because
Sure.
that's confusing to me. Okay.
Sure.
Please. Okay.
So for instance, we had a company that had, and these companies are sold, they're not on the plate today, with very lumpy returns, very high returns at one point, and at other points in the market cycle for this company, seasonal, that it would not be as high returns. We needed to balance that out. So us investing with amazing operators in real estate, what that did was it balanced our cash flow, right?
I got it. You're talking about why you got into real estate. Forgive me for interrupting.
Correct.
Please continue.
Exactly
okay.
Right.
Got it. Okay.
So,
sorry.
on the entrepreneurial side, you're always looking for what the highest leverage, the highest opportunity to get a disproportionate return for X amount of inputs or efforts or investment. So real estate to me is the absolute top of the totem pole, the absolute highest leverage that checks the vast majority of boxes. And so I was always trying to get over to real estate full-time. After selling some companies, we moved to the real estate sector full-time and been focusing on that ever since. And it's to me, it's the best asset class you could be in.
No question. Yeah, I've also built 27 businesses and had a couple of exits. When they fail, I call them seminars. As you know, you said you've suffered through some of my podcasts, and several worth a lot of money, very many flaming seminars. But we fail our way to success as well. So. Did you talk about your progression in real estate particularly? Did you start with single family like everybody does and move up to something else and something else? Talk about that a little bit.
I actually merged the two very early on. I saw that real estate was a huge advantage after seeing some entrepreneurs that I had, were ahead of me, that were mentors, that had exited companies, and they went into real estate with their funds. So I followed in their footsteps, standing on the shoulders of giants. And I just said, well, if I'm going to do this, and I want to do it early, and I want to be as close to the big money, the big deals, the big opportunities as possible. So what's a bigger opportunity than learning from multi-generational family offices, right? Mm-hmm. But if you go in with big family offices, kind of lost in the crowd, it's much more difficult to get to the real players with the real decision-making. So I worked very early on for two smaller family offices, but multi-generational wealth, multi-generational best operating practices. And I worked for free. I begged for a job. And guess what? I got turned down to work for free. So put that in the seminar docket, and at the end of it, it was in the middle of 2008, the 2008 crisis. These guys were holding on for dear lives. They didn't even have extra desks. They didn't want to pay for extra internet. They were absolutely holding on for dear life. And I just said, how do I be involved? How can I be involved and add value to you? Because you already turned me down to work for free. And it was, if you can provide revenue, how can you provide revenue? We don't need operations right now. We're losing those guys. We're getting cut off. We have to cut some of those guys. If you bring in revenue. So I leaned into marketing. I put together a list of 500 investors that wanted to buy apartment buildings. I took that as a bartering chip to take me in as an employee to work for free. And I said, even in the midst of the greatest financial crisis our country has ever had, here's 500 people who want to buy apartments. They're all doctors and dentists and professionals that are insulated to this huge market environment we're in today. And hand this to your brokers and have them freaking call these guys and do some deals. And that should pay for my desk and my phone time and my internet. And that's how I got involved. And since then, I've been able to do a ton of deals with these guys, or I did a ton of deals. I learned their acquisition styles, their off-market buying principles. And at one point in my early 20s, I was carrying about 10 million a week in my jacket pocket, going to the courthouse steps in my early 20s, buying deals in distress. So those were my early days. I got to see a
Okay,
lot.
can I stop you there?
Sure.
You were buying deals in distress. Was it primarily single family at that time?
No,
crash?
because they had too much money. So I started, we jumped. I jumped in my career. We jumped over smaller deals and went straight to commercial.
Okay, so you were buying commercial distress deals in 2010, 11, 12, that the time frame?
Exactly.
Okay,
right.
fantastic. All asset classes or specific asset classes you were buying at that time?
We were partial to commerce, so non-multifamily. I'll put it that way. Multifamily, even today, a lot of great operators that I have huge respect for, and there was just a different class of operator in some of these other asset classes that were lower tier. So we leaned into those.
I see. Okay, fair enough. Like other commercial,
retail, industrial, and office. At that time,
okay,
we would never touch office today, but back then,
that's why you hesitated to say anything.
Absolutely.
I was wondering why you did throw it out there. Good God, anybody that would consider office today, unless they have an easy transition plan, is nuts. Okay, sure. Got it. Okay, so when did you start focusing on industrial, Nic?
So here's a rough lesson I learned is that the market's bigger and smarter than anybody could ever imagine, and times 1,000. Okay, so we did a mixed use retail and office building that we worked our tails off for years, and we got a good return on it. But I learned that the economic forces in that market. This was almost my biggest loss.
Where was it, by the way? Where was it?
It was in Hemet, California. Okay. And if you don't know where that is, God bless you, because it's a very difficult market for syndicators, to say the least. We pulled the deal off because we worked with government agencies to get in and basically pay above market rents, as they typically do. And it was right next to a courthouse. It had a couple tiny things going for it, and it had a mountain of things going against it. We pulled that off by threading the needle, and it was such a difficult deal for so many years that we got by on this, the thinnest of margins of everything to pull it off, that I was like, never again. I'm not doing this ever again. So where's the market going? And we need to drill down onto the economic forces in a much heavier way. So I was able to reinvent that for some of these offices I was working with. And now we have about 50 factors that we follow on the economic side, and industrial is where it took us. Because the future, what it looks like today, if you look at the US and geopolitics and the future of the US economy, a lot of things are onshoring and nearshoring. And I love that. I'm a patriot. I love the US. I'm super bullish on the US long term. I got some concerns in the short term, right?
But let's not go down that rabbit hole. Okay.
I know. So industrial to us was one that was in key markets, a couple key markets, absolutely fits in the trends that we're seeing and we believe has the highest upside in the next 2 decades.
Okay. So first of all, what are the 2 markets you like?
One, I hesitate on the state level, which is California, but on the local level, I like Southern California for industrial. It has the Port of Long Beach and the Port of LA, which is roughly between the two is about 40% of US imports. And it's right next to the Mexican border, which has a huge amount of imports and growing from the Mexican manufacturing industries. So I love that convergence of so many things in one place. Again, I have plenty of thoughts on California's state level government, but the second is I love the Texas Triangle. So, the bulk area of Texas, Again, they have, great port systems. They have great distribution. They hit a huge chunk of the U.S. They have better governance at the state level in many categories. So between those two, that's the vast majority of our focus of the industrial sector.
Gotcha. So for the people that don't understand industrial, can you give us a better description, a micro description of what you mean, what your definition of industrial is, what that looks like?
Sure. So we have this massive economy in the US, the biggest in the world, in fact, by a
Mhm.
very wide margin. So
Mhm.
the question is, how do we feed people? How do we clothe people? How do we provide manufactured goods in the US? How do we provide construction materials? How do we get those places? Those are the big questions so that you, me, and the rest of the US citizens can live our lives and do our daily routines.
Right.
All of that has this huge backbone that's misunderstood or not known at all by most Americans, and that's the industrial sector. We have shipping containers coming from every country in the world coming through only a select few ports in the US, right? We have a
Mhm.
huge network of rail systems and highways and infrastructure that sure could use some improvement at times, but is still pretty damn good compared to many other places in the
Oh
world.
yeah, for sure.
And we have a consumer driven economy where people need and want the things that they need and want.
Right.
And we consume a lot of them. So the industrial sector is the backbone of that. It's if the scale of sexiness in real estate, if there was a scale of sexiness, it might be on the less sexy side because multifamily, clearly it's always a front runner of these beautiful buildings and these, industrial, it's typically concrete, literally poured and tilted up and put together into a gigantic square,
So you're
18
talking about
wheelers.
large warehouse space is what
Correct.
you're talking about. That's what I was looking for. Just so if you guys
Sure.
didn't know what he meant, it's large warehouse space, so big space. You're not talking about the small office warehouse environment where you've got a little carpet installer with a big warehouse behind him or something like that. That's not what you're talking about here. We're talking big storage, which of course it ties into the whole Amazon dynamic, the whole online purchasing dynamic. No, that's sex. That actually is sexy as hell, honestly, when you
On the
describe it the way you
financials, it
did.
looks great, Rod. I got to tell you,
Right,
I've never been
right,
more
right,
attracted to the financials of it, but
right.
yes.
Let's go a little more micro on your acquisition strategy, if you don't mind. So, how do you identify specific deals in one of those two markets you described, which sound like a fantastic legwork that you did to identify those two? Couldn't agree more on that. But how do you identify deals in those markets? What sort of buying criteria do you have? Let's start with that, and then we'll go from there. I'd like a little more micro, if you don't mind.
Absolutely. So again, we are pens down at this current market environment that we're at today. We've
Oh, you
set our
are?
pens down and we're letting the market shake through a few things because multifamily, for instance, with a mini units in a single building has the advantage to ride market cycles up and down. So if you buy
Right.
at the low of multifamily, you can ride that market cycle back up and capture a lot of that upside, even through rents along the way of an improving market. That is not the case with industrial.
Gotcha.
Part of our buying criteria, single tenant,
Hmm.
triple
Oh,
net.
really? Really?
Correct.
Single tenant. So you won't divide one of these buildings in half and have multiple tenants. Well, I was just going to say triple net, guys, means that they pay for everything, the taxes, the common area maintenance, the insurance, everything. Bottom line is that your tenant is paying everything. Bottom line. So
Exactly.
so single tenant, triple net. Okay. So
So
you're buying a building that's already occupied then.
sometimes not. We're okay with either. We're okay with either scenario as long as we're
Okay.
compensated for our additional risk if it's
Right.
vacant. But the real driver for us right now is the fact that we buy deals, meaning we buy discounts. We buy things with a basis. If we only have two or three levers that we ever pull. It's that
Okay.
simple for our acquisition style today, right? Sometimes we're buying at a low basis because industrial buildings that we buy are around 50 to 150,000 square feet. Rod,
Mm.
how much do you think a renovation costs on a building that size?
Well,
Right?
I guess if it's
Yeah.
dated, it could be a problem. But if it's not dated and the bays are the right height, the ceilings are
Sure.
the right height, and all that stuff, like nothing. I mean, what do you do?
Sure.
Hose it out, right? Am I
Sure.
right?
Yeah.
That's
I mean,
it.
but usually these are hard uses. So they're banging stuff up with their big trucks, they're beating things, and that's fine. That's part of business, right?
Right.
On our side, though, some of these renovations can be millions of dollars, right?
Oh, you do
So,
have big renovations. So I thought you
oh yeah,
wouldn't.
oh
Oh,
yeah,
you
oh yeah.
do. What the
So
hell would you be renovating in in a 100,000 square foot building?
So I'll tell you an extreme example.
Okay.
We've redone power for a building, right?
Oh,
That took us
power.
several
Yeah.
$1 million just for that and 5 years
Okay. Okay.
dealing
No,
with
there you go.
dealing.
Okay.
So there's things like that. Now, a lot of times you're dealing with, just a paint job on these can be 50, 60, 100 grand, depending on the
I
size of the
see.
building.
I
So
see.
the scale kills the numbers. And many landlords are not running this with, they're not accruing for expenses. They're not
Mm.
really balancing their books and managing things like a professional. So we come in often and say, look, you can't even renovate this building to market standards. We will buy this at a discount because you don't even have the money to renovate this. Not a lot of people have $3 million just sitting in an account for one building just to get
Hmm.
money, just to release to get their income back. So that's one entry point that we buy it at. The second is we work very often with businesses that maybe towards the tail end of their business cycle that say, look, we still like the business, but we know that this building can be sold for a big profit. So we'll sell it at a discount to market, but you have to give us 5 years of favorable rent.
Yeah, I was thinking self-storage model where you just hose the thing out and you're done. But
No.
so let me ask you this.
Sure.
Do you find that you're very often doing like that electrical job? Was that a tenant finish type of a relationship where you had the tenant that needed that beefed up electrical and please
Correct.
describe that. That was correct. Okay,
Yeah,
got it.
it's
Got
a
it.
high energy use manufacturing. It was
Gotcha.
a niche of a niche, but they were paying significantly higher than market rent. So there was an offset that made it all worth it. You really have to really trust your tenant. You have to trust their credit and all that. But here's the biggest issue is that in a market cycle with highs and lows, like any market cycle in real estate, if you buy too early in industrial, it's the same as being dead wrong because you have a 5-year lease. And if you lease early to somewhat of a market peak on a higher end, you're stuck with below market rents for 5 years.
Wow.
So that's why we love industrial dearly. We think there's a 20-year plan for industrial that's rock solid. But in the near term and the short term, we're looking at we look at the second asset class of
Mortgages.
mortgages. So
Yeah,
that's just
let's
a
wait to
full.
talk about
Sure.
okay, let's wait to talk about mortgages for a second. I want to go back to a couple things you said. Number
Yep.
one, so you buy discounted assets, and I will tell you, let me brag for a minute. We just closed on a beautiful asset in San Antonio. The units next door sold for 137,000 a unit. We bought this one for 100,000 a unit. Same vintage, everything. Screaming deal. And by the way, if you're accredited, text partner to 72345. We still got a couple slots left in that, even though we've closed. It's like I call it a unicorn. It's the only one we bought in 18 months. But the other thing that you said that actually relates to multifamily as well is you talked about where a seller wasn't planning for big upcoming expenses, big renovations, roofs, paint, whatever. And you said they weren't accruing money. In our space, typically, if you've got a loan, a lender will require you to have an escrow. You'll do an escrow every year to take care of things like that. They're not going to assume you know what you're doing. Now, I assume very often you're dealing with sellers that have paid off their debt and they haven't thought about it. You're nodding. That's correct. Yes.
Very
Okay.
common.
So
Very common.
yeah,
Many-year
yeah.
ownership, et cetera.
Right. Okay. All right. Well, let's shift into mortgages. So, you guys you put a fund together to raise money and then you basically make the spread between what you're paying your investors and what you loan the money out on, or you provide a return based on the total return. I don't know how you structure your syndications, but what type of asset classes are you loaning money on? Would be my first question.
That's a great lead into it is we
Okay.
buy on the secondary market of single family mortgages, meaning banks originate, right? Banks and lenders originate, and then we buy on the second hand. So when they have a hiccup, like let's say, for instance, COVID happens, a global pandemic, and maybe there's furloughs or layoffs, et cetera, and someone doesn't pay for 6 months, but they live in the home with their family, they have good credit other than that period of time where they had a hiccup, we step in for those lenders and say, hey, we're happy to buy that at a discount. right? And the reason for this, and the reason we went that direction was, again, I bought foreclosures for so long on the courthouse steps that one step above foreclosures is buying the actual mortgages, buying the actual notes. So that was a progression in our business. Previously, we built long-term relationships with a lot of these amazing lenders that trusted us. We were showing up with big checks. We had long-term. They knew if we showed up, we were going to deliver and it was going to be paid, right? And
Yeah.
so we had the credibility of that space. So now where we're at today is our investors, many of them were aging. They're getting older. And they said, look, Nic, you had great returns. We really enjoyed the syndication side. We really want just something that's more stable, more fixed, high return still, that's dependable. What could we see that's just rock solid? We get a check in the mail every month. And so our solution to that question was to lean more into the mortgage space, which, look, we have a unique market in this country, Rod, where 98% of mortgages are fixed rate mortgages in the United States. That is not the rest of the world. So the rest of the world, if they have low rates, 2-3% mortgages, those get sorted through every 5 to 7 years because rates adjust. The shorter term mortgage terms, right? Not in the US. And I love the long-term status of our markets or of our mortgage market. And I see a huge, compelling, strong long-term trend there, while we have the lowest inventory in history for housing at the same time.
So I've got some questions and
Sure.
a little bit of pushback, just because I want to push back and see how you respond. But let me ask the questions first. So when you're purchasing these mortgages, what sort of discounts can you anticipate? Is there a range, or is it deal specific, or can you speak to that a little bit? Let's start there.
So I'll frame the answer and then I'll give you the exact answer. Very rarely do you buy one-off mortgages. You can.
Right. No, you buy a pool. Got it.
You buy a pool. Exactly right. You buy a pool, and that's the most common purchase structure that you buy it under is many mortgages at a time. So under that pool, you can get away with some deeper discounts on certain assets that maybe they value less, and others they're just kind of like pound sand. If you want the gold, pay for it, right? And so on our side, we typically budget in the mid to high 20% discount. So
Gotcha.
I think our last calculation was around 27% discount that we get on different deals. And some of that are very, very, very rock solid mortgages. Others are ones that we have higher concerns of foreclosure. We at Saint, our business model, we don't like the foreclosure side. We're thinking long-term. We're not trying to get a short-term bump. We're looking for a long-term yield. So oftentimes we'll just resell those. But on average, to answer your question directly, it's around 27%, I think was the last calculation on that.
Okay. And then you've got the future value of that money that comes into play when you're discounting these mortgages, correct? That's a big factor. Do you have a team that tries to work with some of these distressed borrowers? Do you have a back office team? Because I know that's very common for people that do what you do. Yes?
Absolutely. So there's things, and you know this, I don't need to, but just for the audience to give my perspective on something you already know, there's things that you can outsource very effectively. Property management, if you manage your property managers well, they can be fantastic. It's a harder, it's a hard position for anyone, but you can outsource that in a big way. The things we never outsource at Saint are things that have the highest leverage for returns, right? So asset management, we do in-house. Inevitably, we always do in-house. Even key leasing, we manage either doing the actual negotiation ourselves or doing it in-house. What your question was, is in that category where we're extremely close to the workouts of these loans, because each tiny variable does matter for the yield to make sure that our investors can get a good return, we can get a good return, and we can pay the highest that makes sense to the banks so that you have a win-win-win scenario. That's a long-term business strategy that we want to lean into. So yes, we're very close to it.
Okay, so the next question pre-frames my pushback. Loan to value that you look for in a portfolio.
This is a key question, because we could go out there and push really, really, really risky deals that are, let's say break-even deals on loan to value. Our average equity is 29% on the loans we buy. So we tend to keep it pretty conservative. We want the homeowner to have a lot to lose, because that means they have a lot to gain by paying their mortgage every month and all of us working positively together.
Or have some spread to be able to sell if the shit hits the fan. Correct?
And if you look at like
Correct.
Vegas in 2008,
Right.
the wake of 2008, you need some
Dude,
spread, right? You
let
need
me
some.
let me no, you need more than some spread, which is my pushback, okay, on this
Yeah,
model. Because if the proverbial shit hits the fan, which I'm anticipating, frankly, I'm excited about because I think there's going to be incredible opportunity. Um, it was these homeowners that got in trouble, and I can tell you my portfolio here. This is going to shock you. I had 800 houses along the Gulf Coast of Florida, and I was at a 30% loan to value. Okay, 30%. That's all I owed. I went upside down by the end of 2009. That's how much it dropped here. Okay, so it dropped about 70% here in Florida, which people are like, that's insane. Yes, it was insane. And I think we had, significant drops elsewhere in the country. Do you look at, and I didn't even ask you this, I think when you buy a pool, you pretty much get them all over, don't you? It's not like you can be geographically specific. Can you speak to the geography of your portfolio?
sure. We are in 21 states no,
Yeah,
excuse me,
yeah.
over
So it's
21 states. It
okay.
fluctuates, but we want to be in about half the country at any given time. There's another half that's a little less interesting. There's a little less upside on growth, et cetera. But we're in about 20 plus markets at any given time. We like the spread. We like the distribution of that.
Yeah.
Also, yeah, there's some states that are less desirable, right? You deal with like certain states like, maybe New York's a little tougher, maybe California's a little tougher. You have some Ohio's and some others in there that are a little bit
Mhm.
tougher. But generally speaking, the distribution and the spread of our portfolio is part of the strength of it,
Yeah.
right?
Yeah. No, that makes complete sense. And that's good because, like even when 08-09 happened, the Midwest wasn't as crushed as the rest, the coastlines, Vegas, they got freaking crushed. But the Midwest, puddled along. So, if you've got some diversity there, that absolutely is some safety for sure. Okay, fair enough. Good answer. So let's talk about your opinion about the market right now. I told you before we started recording, I'm very bearish. I think the proverbial, what is going to hit the fan here after the election specifically, but because I think they've been propping it up. But I'd love to get your opinion.
I'm not as doom and gloom, but I'm doom
Right?
and gloom very heavily in a few points. For me,
Okay.
inflation has been the least managed, the
Right.
most poorly communicated, and I don't know. I mean, if you really wanted me to drill down, I don't know if the Federal Reserve has been uh, just not saying correct information and they know the opposite, meaning lying through their teeth.
I was going to say misstated. I didn't want to interrupt because I do that too much, but I was going to add misstated to those other things you just said.
So
Yeah.
let's say if you were to use an extreme, on one hand, they could be lying through their teeth. On the other hand, there could be a wide, massive amount of incompetence as far as their communication or their tracking, et cetera. It can only be one of those two, Rod. It can
Yeah,
only be one of
agreed.
those two
It
with
could,
how
it
far
could,
off
it
they
could, it
get.
could be, it could be both, frankly, especially on the incompetence side. But don't get me started. What's your crystal ball, brother? What's your crystal ball? I mean, do you feel like there could be opportunity for people like us that are in some cash, have access to cash, and if so, what asset classes? I mean, I feel very strongly there's going to be deals in multifamily. There's a lot of operators with bridge debt that are struggling. I've got a couple myself that I'm dealing with the lenders on right now. You know, sorry, I'll stop talking. What are your thoughts?
I'm very similar to what the sentiment that you're going through. To give you the backdrop of what we're seeing, again, we track a ton. We have economic trackers, flying out of our ears for what we're looking for. This is what we're seeing. Here are the big trends, and then this is what we're seeing in the U.S. The green economy, remilitarization of the entire world, including the U.S., heavily supporting that. Infrastructure buildouts, restructuring of global and domestic trade, fiscal deficit. These are all super inflationary. Every single one of those, right? If you think about the entire history of the United States, right? The US empire that we're in today, since 2020, 80% of every dollar in history has been created. So in hundreds of years, we printed only 20% of every dollar that ever existed. And in, let's say, 4-ish years, we've printed 80% of every dollar that's ever existed in the US history. Go ahead. Go ahead. You have so
No,
okay.
I am shocked by that one, buddy. I'm actually getting interviewed myself later this week, and I'm absolutely stealing that one. That is holy cow. That's
That's a kick in the
crazy.
gut. And so to
Right.
give perspective, so in 2020, so at the beginning of 2020, we had around 4 trillion in circulation. Now, today, there's 19 trillion in US dollar circulation, around 400% increase in just a few years. So while we're scratching our heads going, gee whiz, I wonder where inflation's coming from, right?
Yeah,
That's
right.
one number. At the beginning, just again, to set the table for this, at the beginning of 2021, Rod, inflation was at 1.4%. Now, again, I won't get political, but just so we understand timelines here, that is the same time that Joe Biden took office. Okay.
Okay.
Not to get
You won't get
political.
political, but we will throw that in. And I'm glad you did. And I'm glad you did.
Just to note, I'm
Yeah.
I'm a lifelong independent, but I think
Okay.
it's very important to understand political timelines on things as well. Now,
Yeah.
from January 2021, when inflation was at 1.4%, to when Janet Yellen came out and said resoundingly the famous phrase, inflation is transitory. Remember this?
Mm-hmm.
You know this. I know this. Real estate investors that are professionals know this. We all wanted to puke because we knew that was not the case. It couldn't exist in the world we lived in. You speed up 18 months, Rod, to the middle of June 2022, 9.1% inflation. So we went from, in a short period of time, 1.4% inflation to 9.1% inflation. And the Federal Reserve's largest talking point, their largest soundbite, was inflation was transitory. So again, I go back to the saying, you have to pick a path. Is the Fed incompetent on one side, or were they lying? I don't know. I'm not in those meetings, right? But you can't be one of those. It can only be one of those. So since then, we have seen a reduction, thank God. But that's on the heels of the largest and steepest rate hike in history. Now, in the 70s and 80s, there was a higher peak of what the total market rate was for mortgages. But we saw a steeper peak in the post 9.1% inflation era, where I think we went up like almost 4% on interest rates in a short period of time.
Yeah.
So now we're stuck right around 3.5%, where we're at today.
I'm
All
sorry.
kinds of
What,
weird.
you mean inflation at 3.5%?
Correct. Sorry.
If we believe what they give us, there is that.
I couldn't even unpeel that. I couldn't unpeel that onion because there's so many layers to exactly what you said. But if you take it at face value of the CPI, that there's no fudgery in there and all that, you're looking in the mid threes. But we still, even with what they're telling us, if it's accurate, which there's a lot of concern as to the contrary, if that's accurate, the precursors to CPI, things like PPI, the producer price index, is still increasing, right? So even the forward-looking estimates show that inflation is not just sticky, it's getting worse. So just to drill it back down into, give it to the audience of what all this means, because there's a lot there. It means that inflation is not solved for. When you look at the indicators that the Federal Reserve looks at, CPI, PCE, which are the main ones that they look at, and then the precursors, which are PPI, the producers, what the manufacturers. This is important to me, Rod, and industrial. I want to know what producers are experiencing in their businesses, the cost increases that they have to deal with, because that comes back to us, the consumers, right?
Of course it does.
The whole country is impacted. So that's what I'm seeing in the market. Now, to answer your question, what to do about it, it's great that we can talk about doom or gloom or highs or lows. What would I do about it? What's my thoughts? There's this old saying that was going around when the Fed was just pumping out money before we got hit in the face by inflation. Don't fight the Fed. You remember that was such a popular saying. I'm still in that boat, not because they're so competent and they're so forward thinking, but because they control such a big freaking wallet. So on my side, with inflation being what it is, I think there's only two paths. You either invest in assets that appreciate with inflation, or you invest
real estate. Yeah.
Hey, it's all real estate, baby, right? Like I'm a real estate dog, right?
Right.
And then the other is you invest in assets where the underlying value is propped up by increases in value. So that, to me, I'm either investing in syndications in real estate or mortgages.
Yeah.
That's where we have found the most value, to answer that question in a really long run.
I believe it's the safest as well, for sure. And so, well, listen, brother, I really appreciate you coming on the show. This has been a delightful conversation, and on that note, let's do this again when you can come to Florida. Okay, I've enjoyed this that much. Okay, let's definitely do this again. Well, listen, I appreciate you coming on, and look forward to continuing this dialogue. Let's plan to do it after the election, or like first quarter next year, and let's circle back and just see if we're complete idiots, or I am, because I think it's going to get freaking very interesting. So we'll see. But really enjoyed it, brother. So
Me
thanks.
too, Rod.
All right, take care. See ya.
Thanks again.